Is it still smart to invest only in the US in 2026? Or are global markets finally starting to catch up? In this video, we're revisiting one of the biggest investing questions, VTI versus VXUS, and what's actually changed going into 2026. Welcome back to Asset Index. If you've seen my previous VTI versus VXUS breakdown, you already know this is one of the most important decisions long-term investors face. But markets evolve, and what worked last year doesn't always work next year. So today, we're updating the strategy for 2026, using real data, not hype. Let's start with a quick recap. VTI gives you exposure to the entire US stock market. Over 4,000 companies, large, mid, and small cap. VXUS gives you exposure to everything outside the US, over 7,000 companies across Europe, Asia, and emerging markets. So this is essentially a decision between betting on the US or betting on the entire world. Now here's where things start to shift going into 2026. For most of the last decade, the US dominated global markets, driven largely by big tech companies like Apple, Microsoft, and Nvidia. But heading into 2026, a few things are changing. US stocks are still relatively expensive compared to global markets. International stocks are trading at lower valuations. And emerging markets are starting to show stronger growth potential. This doesn't mean the US is done outperforming, but it does mean the gap is worth paying attention to. Now let's talk about performance. Historically, VTI has averaged around 10% annual returns over the long term. VXUS has lagged behind in recent years, but if you zoom out further, there were entire decades where international stocks outperformed the US. So the real question becomes, are we entering a new cycle? Now let's look at risk and diversification. If you only hold VTI, you are 100% dependent on the US economy. If you add VXUS, you spread your risk across different currencies, different governments, and different economic cycles. This is what diversification actually means, not just owning more stocks, but owning different sources of return. Now let's talk about income. Here's something many investors overlook. VXUS often has a higher dividend yield than VTI. That means more income potential, more reinvestment opportunities, and potentially stronger compounding in certain environments. But again, this comes with trade-offs in growth. Now let's walk through a simple portfolio example. Let's say you're building a portfolio in 2026. Option 1, 100% VTI, pure US exposure. Option 2, 80% VTI and 20% VXUS, slight global diversification. Option 3, 60% VTI and 40% VXUS. More balanced global exposure. Each of these strategies will perform differently depending on market cycles. So which one is better? Here's the reality. There is no single best answer. If you believe in continued US dominance, VTI alone might make sense. If you want global diversification, adding VXUS becomes important. And many long-term investors choose both. Because the goal isn't to perfectly predict the winner. It's to build a portfolio that can survive different market environments. So should you invest only in the US in 2026? Or go global? The better question might be, how much global exposure makes sense for your strategy? Because in the long run, investing isn't about maximizing returns every single year. It's about staying consistent, staying invested, and letting compounding do the work over time. If you found this breakdown helpful, subscribe to Asset Index. We break down ETF strategies, passive income, and long-term investing using real data you can actually use.